Imagine a scenario where two individuals, both having received their first significant paychecks, decide to save $5,000 each. They open new brokerage accounts considering their next move. One is contemplating investing in a few promising individual stocks, while the other leans toward the widely recommended approach of investing in an S&P 500 ETF. Fast forward 10 years, one investment has grown to $9,000, a respectable 80% return. However, the other portfolio has surpassed $20,000, a remarkable 300% increase, all due to a single choice made at the beginning of the journey. This video explores what could happen to a $5,000 investment over 5, 10, and 20 years using different strategies. It concludes by revealing a powerful hybrid method favored by professional investors, one that has the potential to double average returns. The video aims to resolve the ultimate investment debate: ETFs versus individual stocks, using real data and examples to help determine which approach aligns best with different financial goals. Understanding the fundamental difference between ETFs and individual stocks is essential. Exchange-traded funds, or ETFs, are comparable to baskets of investments. This is similar to shopping for fruit, either selecting individual fruits like apples and bananas or purchasing a pre-assembled fruit basket containing a variety. An ETF functions like the basket, offering instant diversification. In contrast, purchasing an individual stock, such as Apple, means investing in a single company. The investor benefits directly from the company's performance, but also bears the full risk of any setbacks it faces. With an ETF like VOO, an investor owns fractional shares in hundreds of companies, spreading risk across multiple sectors. While ETFs are typically associated with diversification and individual stocks with growth, this oversimplification overlooks important nuances that significantly influence returns. To demonstrate these differences, consider two distinct investment paths. The first path represents a passive ETF approach, labeled the Sleep Well at Night strategy. This involves placing the entire $5,000 into the Vanguard S&P 500 ETF. This single purchase provides exposure to 500 leading U.S. companies. With an annual fee of only 0.03%, or about $1.50 per year on a $5,000 investment, this strategy evolves with the market. The index regularly updates, removing underperforming companies and adding rising ones. Historically, this method has averaged approximately 10% annual returns. With this approach, the $5,000 could grow to around $8,500 after 5 years, $13,000 after 10 years, and $33,600 after 20 years, all without requiring ongoing research or monitoring. The second path is the bold stock strategy. In this case, the entire $5,000 is invested in Apple stock during a time when the company was best known for its iPhones and iPads. The reasoning behind this decision is the frequency with which consumers replace Apple devices, creating a reliable revenue stream, as well as the loyalty generated by the Apple ecosystem. If this investment had been made 10 years ago, it would now be worth approximately $55,000, a staggering 1,000% return. However, such growth came with significant volatility. Apple's stock declined nearly 45% in 2013 due to concerns about innovation and dropped another 31% in 2020 during the COVID-19 market crash. Many investors tend to panic and sell during such downturns, missing out on subsequent recoveries. Comparing the two paths highlights the contrast in outcomes. The ETF route grows $5,000 to roughly $13,000 in 10 years, representing a 160% return. The individual stock route grows the same initial investment to about $55,000, yielding a 1,000% return. This substantial difference illustrates why some investors prefer individual stocks. However, there's another side to the story. Research shows that most individual investors underperform the market, regardless of the method chosen. ETF investors often engage in excessive trading, which erodes returns. Data indicates that the average index fund investor earns about 2% less than the actual fund due to poor timing, buying high and selling low. For stock pickers, the underperformance is even more severe. According to Dalbar, the average equity investor has earned just 5.96% annually over the past 30 years, while the S&P 500 delivered 9.71%. This gap is attributed to emotional decision-making, overconfidence, lack of diversification, and unsuccessful market timing. The key takeaway is that investment strategies must align with individual temperaments. Even the best-performing strategy is ineffective if the investor cannot maintain discipline during market fluctuations. To address this, financial professionals often recommend the core and explore strategy, which balances safety and growth. This approach involves dedicating 70 to 80% of a portfolio to broad market ETFs, forming the core. This portion might include 60% in a U.S. market ETF like VTI and 20% in an international ETF such as VXUS. This core offers stable exposure to thousands of companies worldwide, capturing global growth with minimal risk and low fees. The remaining 20 to 30% is allocated to the Explore section, where individual stock selections come into play. Investors are encouraged to choose companies whose products or services they understand and use, limit each stock to 2 to 5% of their total portfolio, and commit to holding for at least 5 years. Documenting the rationale before investing is also advised. For example, with a $10,000 portfolio, $7,500 would be allocated to ETFs and $2,500 spread across 3 to 5 individual stocks. If the entire portfolio grows at 10% annually, the total reaches approximately $25,937 in 10 years, similar to a pure ETF strategy. However, if even one stock performs exceptionally well, achieving 20% annual growth, the portfolio could rise to $30,727, delivering an additional $4,790 without excessive risk. To determine the right balance, financial experts rely on a 4-question framework. First, assess how much time is available for research. With less than 2 hours per month, allocate 90% to ETFs. For 2 to 5 hours, use an 80-20 split. If more than 5 hours can be devoted, a 70-30 allocation is recommended. Second, evaluate reactions to market volatility. If market swings cause significant anxiety, stick with 90% ETFs. If discomfort is mild but manageable, allocate 70 to 80% to ETFs. Those who see market dips as buying opportunities can invest 50 to 70% in ETFs. Third, consider the investment time horizon. For less than 5 years, keep 90% in ETFs. For a 5 to 10-year horizon, allocate 70 to 80% to ETFs. For timelines beyond 10 years, a 50 to 70% ETF allocation is suitable. Finally, define the primary financial goal. If preserving wealth is the aim, invest 90% in ETFs. For steady growth with moderate risk, allocate 70 to 80%. For maximum potential growth, 50 to 70% in ETFs is appropriate. By answering these 4 questions, individuals can tailor an investment strategy that balances growth, risk, and personal preferences. This thoughtful approach increases the likelihood of long-term success and wealth creation. Thanks for watching InvestingFlix, where smart money learns smarter moves. Subscribe for more insights that grow your wealth.